Hello clients and friends, I'm Paul Hutton, President and Wealth Manager with Hutton Wealth Management, and it is my pleasure to bring to you our mid-year economic update. At Hutton Wealth Management, we partner with our clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is powerful. And one of our missions is to share with our clients is the knowledge that we have that can better help them in making informed decisions. Today's agenda is pretty straightforward. Again, first, I will share a brief investors update on the first half of 2022, and then we're going to discuss some ideas and some strategies for you to consider. Before we get started, I find it always important to review that there are 5 key areas to financial planning. And they are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is primarily about equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation that we make, not just in one of these areas, but in all of these areas for our clients. It's so important. So now that we got that out of the way, let's address the big giant elephant in the room. Investors have seen multiple record highs over the past few years in the stock market, and we knew that at some point this market was going to have to make a correction. Market correction was inevitable, and the Dow Jones Industrial Average just registered its worst half of the year since 1962, and the S&P 500 had its worst year since 1970. This type of market movement, although it happens and it's unpleasant to watch, can make even the most patient investors uncomfortable. The brunt of the downturn was in the first few months of the first half, and the result is the Dow ended up the first half of 2022 down 11.3%. And the S&P 500 closed the first 6 months of the year down 16.4%. This is a far cry from the bull market, where investors were treated to equity markets that moved more than double digits between March of 2020 lows until January of 2022. This was a time to remember one of Warren Buffett's famous quotes, where he once said, "The stock market is a device for transferring money from impatient people to patient people." I want you to think about that. That's what's happening right now. It's key for investors to remember that equities are long-term investments, and any panic-driven impromptu moves that deviate from your plan could be very costly to you. So let's review this quarter's bumpy ride. The second quarter continued this year's theme of heavy volatility, and the S&P 500 is officially in a bear market. The Federal Reserve raised interest rates 0.75% on June 15th. This was the biggest rate hike since 1994. Their narrative said we should expect additional rate hikes this year. We're anticipating another rate hike in July. And that would put our Fed funds rate between 2.5 and 2.75%. Inflation is still an issue for consumers, and we have yet to see the Fed's defense of raising rates will work and cause a retreat in the inflation rate. This world continues to see unrest, particularly in the war over in Ukraine as well. Also, let's not forget about COVID. China, the second largest economy in the world and a manufacturer of mass products, still holds a zero COVID policy and could have lockdowns that have supply chain effects in the market today. In summary, this has been a very unrestful quarter. It's been very unrestful last 6 months. And this is a good time for investors to keep in mind that even though we have experienced a downturn, the S&P 500 is still well above the 2020 low caused by the pandemic. Once again, equities are long-term investments, and you need to remember that. As we mentioned, the S&P 500 is officially in a bear market. A bear market is defined as when the market drops 20% below a previous high. As uncomfortable as it is, this is a normal part of the investment experience. It's uncomfortable, but it's normal. The good news is that historically, bear markets last for a significantly less amount of time than bull markets do. Bears last on average 9.6 months, while bull markets last on average 2.7 years. The long-term average frequency between a bear market is 3.6 years. This means that an investor could see about 14 bear markets in a 50-year investment window. Since 1930, the market has been bearish for a total time period equal to 20.6 years. And this means that stocks have been on the rise for over 71.4 years. Think about that. Many reports are saying that recessions usually follow bear markets. However, facts share that of the 26 record bear markets, a little more than half came with a recession. So what's a recession? A recession can be a really scary word that the news uses a lot. So let's quickly address what a recession is. The actual definition of a recession is defined by the National Bureau of Economic Research Business Cycles Dating Committee. They explain that a recession involves a significant decline in economic activity that is spread across the economy and lasts for more than a few months. While we now have had 2 consecutive quarters of declining gross domestic product, or GDC, in the U.S., the Department of Labor statistics shows unemployment still at a low of 3.6% in May, the lowest since the pandemic, and consumer spending is still strong despite inflation. Remember, equity markets are still well above pandemic drives and declines from where we were at in 2020. While possible, numerous experts believe we will not see a recession in the near future. However, there is cause for concern, and we are keeping a very close eye on the economic environment and the indicators of a recession. Please also understand that even if we do go into a recession, this does not mean that investors are going to get wiped out. Remember that a recession does not equal the Great Depression. Although there is no established formal inflation target, the Federal Reserve generally believes that the approximately a 2% rate of inflation is acceptable. Between the start of 1991 and the end of 2019, year-over-year inflation averaged about 2.3% and exceeded 5% only 4 times. The U.S. inflation rate rose to 9.1% in June, up from 8.6% in May, and this is the highest since November of 1981, and that means that inflation is at a 40-year high. So where are we seeing inflation the most? We're seeing it in car prices, gas prices, grocery bills, housing costs. Prices saw heavy increases all across the board. So let's take a brief look at the Federal Reserve's main tool to fight inflation, and that's using rising interest rates. Historically, it works very well. Inflation happens when there is a supply and demand imbalance. There is a large demand for products or goods, but a limited supply of such. This demand increases the price of the said goods, and this is what is called inflation. When the rate of inflation gains steam too fast, the Federal Reserve attempts to slow it down by increasing the Fed funds rate, or the borrowing power, and reduces its bond holdings. This makes it more expensive to borrow money, thus reducing the purchase power for consumers. This should slow down spending. The Fed's expected result is that the forward momentum of inflation rates slows down and the supply versus demand becomes more balanced, therefore slowing the rate of inflation. Standing by its commitment to fight inflation, on June 15th, the Federal Reserve again raised interest rates by 0.75%. That's the biggest single rate hike since 1994. Add that to the 0.75 increase already implemented this year, and this brings the Federal Reserve Fed fund rate target range from 1.5 to 1.75%. Wall Street responded with a sell-off, taking the S&P 500 officially into the bear markets. In late June, the Dow Jones Industrial Average dropped below 30,000 for the first time since 2021. One area seeing a big impact due to inflation and interest rate increases is the housing prices and mortgage rates. Housing prices have soared recently, but now that mortgage rates are significantly increasing, we may see home growth prices fall back closer to historical average by the end of this year. Let's hope for that. As you can see from this infograph, a 3% to 6% interest rate has a major impact on the average 30-year loan. For example, on a $500,000 home, the ticket price may be $500,000, but at the end of the 30-year mortgage, if you paid 6% interest, that home actually cost you $863,000 versus $607,000 if you'd have had a 3% loan. That's $256,000. What would you do with $256,000? It's been a while since investors have seen bonds paying decent yields. This historical low interest rate that we saw since the pandemic-driven global crisis did not make bonds very favorable. Now with the Fed raising interest rates this past quarter, bond prices that were lower, and now those yields are beginning to rise. At the opening of the week, the Fed announced an interest rate increase. The benchmark 10-year Treasury note was 3.3% and the 30-year Treasury note was 3.37%. The 10-year Treasury note yield closed the quarter at 2.97%, while the 30-year Treasury note closed at 3.125%. Investors seeking a safer alternative to equity amidst market volatility, rising interest rates, and tightening financial conditions are now seeing bonds in a more favorable light. Keep in mind that bond investing can be tricky. We're monitoring how the Fed's movements in raising interest rates are affecting those bond yields. Safety comes with a cost. Have you seen what interest rates are currently offering savers? According to Barron's, the average bank money market rate on a July 4th was 0.09%, and the average 12-month CD was 0.39%. For many investors, today's ultra-low rates might not help them reach their goals very well. Therefore, equities should be considered for part of a diversified portfolio. Being knowledgeable of the cycle of the emotional investing is also very wise. It is a theory every investor should understand well. This current market environment is most certainly testing the discipline of investors. Some investors panic and jump ship during times of volatility, while others choose to ride it out and wait for calmer waters. Which mindset do you have? Having a comprehensive financial plan takes into consideration how you will react to each cycle before it happens. This helps you make the best non-emotional decisions, non-hasty decisions for your hard-earned money. And we feel that volatility isn't likely to go away in the coming month, so investors need to be prepared. Remember, if you have a well-diversified long-term financial plan, abandoning ship is probably not in your best interest. As you can see from this chart, even with a downturn, long-term investors who have stayed in the market over 10, 20, or 40 years were rewarded with considerable gains. Please remember, investing in equities should be viewed as a long-term commitment, and I stress a long-term commitment, not 1 year, a long-term commitment. We do not have a predictive power, but we do understand that equity investors can attempt to best meet their goals over long periods of time. Historically, investors with a long-term plan that stayed the course and remained invested were rewarded. Now let's review our outlook for the upcoming months ahead. In the approaching months, we expect to see more interest rate hikes ahead from the Federal Reserve. The cost of loans are higher, most notably mortgage rates. If you're planning on any large interest-bearing purchases, you may want to consider having liquidity for any of those purchases. As we mentioned earlier, there are still many variables like geopolitical unrest that are continuing health concerns that could affect the speed and the direction of the economy. We are keeping a watchful eye on the events or changes that may affect your personal situation. So here's some things that we feel would be beneficial for you to do in light of rising interest rates. Let's focus on the things that we can control. Let's start by reviewing your income-producing investments. Let's lock in your mortgage rates if you're considering refinancing to get a better rate, if you haven't already done so. Again, maintain liquidity for all near-term needs. I always recommend 3 to 6 months in a savings account. Reevaluate and confirm your cash flow needs. It needs to be done at least once a year. There's something else if you'd like for us to, we'd be happy to help you with. Look into a Roth IRA conversions. If your IRA is not a Roth IRA and your value is down, this may be a good time to see if converting it to a Roth IRA makes sense. This process is complicated and needs to be evaluated by a qualified professional first. If this is you, feel free to talk to me about it. Bring it up at your next review and we will sit down and go over that with you. Next, sometime this year, we need to conduct a full review of your financial plan. During this review, we can look at risk management, how well diversified your plan is, and revisit your time horizons to make sure all of these items are still compatible with your goals. The last few years have reminded us that anything can happen, anything. That's why we always abide by our mantra to proceed with caution. These are very challenging times for investors, and we want you to be comfortable knowing that we are staying apprised of all the situations going on that may affect you. Having a proactive approach to your financial goals and a solid investment strategy is part of the holistic offerings that we provide for our clients. As a quick recap, here's some key areas and some things that we want you to take away. Remember, the S&P 500 is officially in a bear market, so be careful. The Federal Reserve raised interest rates 0.75% in June and is expecting to raise them 0.75% in July as well. Inflation is still an issue for consumers. The CPI had its highest increase since December of 1981. The Fed is positioned to raise interest rates again at their July meeting. Volatility looks like it's going to be here for a while, so we need to be prepared for that as well. Very importantly, staying the course and maintaining consistency of a well-diversified portfolio has historically served investors very well. Understanding the cycles of investing emotions can be very helpful. Remember, we are here for you to discuss any concerns that you may have. While we cannot control the financial markets, inflation, interest rates, the presidency, Congress, or any of that, we will keep a watchful eye on them. These are all challenging times for investors, and we want you to be comfortable knowing that we are staying apprised of any situation that may have an effect on you. On a final note, we started with a quote by Warren Buffett, and I want to leave you with another quote by Warren Buffett, who said, "Successful investing takes time, discipline, and patience." I want to thank you so much for attending our online presentation of this workshop. We appreciate all of our clients, love you, pray for you. As a client benefit, you can add names to our distribution list to receive newsletters and presentations like this one. We hope you will take advantage of this and add 2 names or more to our list. One of our goals for 2022 is to continue to help others just like you. Remember that some of our best clients were referred to us by existing clients. So please feel comfortable letting us know the names of anyone who you feel could benefit from our services or information. Again, one of our primary goals is to keep clients informed, and we appreciate you watching our update. Please call us if you have any questions. God bless.